right, well, welcome along, everybody, to this Thursday afternoon market recap. What I'm going to do for you over the next maybe 10 or 15 minutes is just recap just what has taken place over the next 2 days and what to look for moving forward. Obviously, right, tension is high when you see markets pull on back down, especially now. This is the second day after the Fed spoke yesterday, whereby we are seeing essentially the back test of what has been that of a breakout of these all-time highs. It's very interesting to me, someone who follows the market as closely as what I do each and every day, and also interacting with a lot of people around the world, just to sort of comment on and at least have a gauge anyway of the, I guess, the sentiment, not only coming from the people who I'm relatively close with through Pro and people I deal with anyway when it comes to technical analysis, but also for, I guess, a wider community of people who follow the financial markets. Obviously, yesterday the Fed spoke. They cut by 25 points. Obviously, it wasn't enough or satisfactory enough to see the markets elevated up and around these resistance areas. As such, they pulled on back down. We started to see that lower wick as at the close on Wednesday, or at least intra-session during yesterday's session. Today, however, we started off relatively good, but again on the back of trade comments by President Trump, you saw the markets tank towards at least the midsection of the afternoon, and we closed down a further almost 27 points on the S&P 500. It's really interesting once again to comment on the sentiment, the mood, the psychology of active market participants, and how, again, the distortion or the perception of the market changes when you see a couple of negative sessions when it comes to the financial indices, not only for the S&P 500, but very quickly, if I change it over to the Dow Jones Industrial Average, you can see we closed down a further 280 points as at Thursday's close. And on the NASDAQ, again, down 64 points. What is common, or the commonality between all of these markets, again, is this upper wick, which was really the markets just clawing back a lot of the losses that were made on Wednesday prior to, of course, the most recent sort of trade tweet by President Trump, again on the Dow Jones Industrial Average, that upper wick here, whereby we started to see the markets at least again claw back a lot of those losses at Wednesday. We pretty much got back to sort of that neutral point. Really interesting. However, again, the sellers took hold of the market. A couple of things to point out, as I've already alluded to publicly and also privately. This sort of retracement here that we're seeing, it really shouldn't come as a surprise. We've speculated in the past, all right, or pontificated in the past about a sort of a movement in this type of sort of scenario whereby we actually backtest, all right, the recent breakout pivot. Now, again, during the month of June, we actually thought that perhaps this was it. It was very brief during this sort of bull flag in retrospect type of period. We continued higher really to the midsection of July. Again, we got a secondary push higher towards the back end of July, but what has been the final session of July into the first session of August has been relatively bearish, so to speak. But what people are missing out on is, again, still the process of generally the backtest that occurs once you see markets, or actually individual stocks or even Forex, once it breaks out of a range-bound state. That is really, all right, if there's anything that you can take away from this particular recording, it's the general backtest that occurs after a breakout. And that is exactly what appears to be under construction, which is more so on a larger time frame than what, again, we thought was occurring in the period of June, but we were still sort of skeptical as to it potentially unfolding. What I can say from the outset of this recording is that, again, like we spoke about during the fourth quarter of 2018, during this period here, we're still looking at the market trading at a discount at the moment. It seems a little bit absurd to say so, but during these pullbacks, okay, I want you to sort of remind yourself of the change in sentiment that occurred during the sell-off in the fourth quarter of 2018, and more recently during the period of May. Understanding again that obviously the media, market pundits, are going to try and tie news stories to obviously the movement in price direction of the market as such, really trying to sort of confuse you as to really what is going on underneath the surface. I want to remind you again that very importantly, we are still very much so bullish on the overall state of the markets. Mind you, we are still looking at what I spoke about yesterday in that public update. We were talking about the C, all right, the C for confluence. And I just wanted to point out a couple of things on the S&P 500, hopefully just to sort of put any concerns to rest at this particular point. It's always interesting. I get a bunch of emails trickling through asking for my updated sort of views on the market after days like today and also after days like Wednesday. And that's really why I'm sitting down at this particular juncture anyway, to bring you this recording. What I wanted to point out is, first of all, the high of this candlestick over here. Okay, this white candle over here. This is when essentially we got the gap, what seemed to be that of a measuring gap, a continuation gap, as we led into the first session of July. You can see the high price is 2,943.98. Let's just round it up to 2,944. If you have a look at the L candlestick now, you can see over here that the low of today's candlestick was 2,945. So pretty much more or less to 1 point. okay, we have now closed the gap on the S&P 500. Technically, it's still open. We've got a point and a bit to really close it, but as it stands, we've pretty much closed this open window. And generally, again, windows need to be closed, and they don't necessarily need to be closed, but generally what happens is, especially on market indices, is that the markets will close these types of windows. And that's exactly what is under construction now on the S&P 500. In fact, what we've been speaking about since we've broken out is the back test and the potential, right? Best case scenario of entering back into the market, or at least accumulating or dollar cost averaging into positions if the S&P 500 was to or were to fall into the range of roughly 2,960, I think we said, all the way down to 2,900. It makes a lot of sense given, of course, right, the general psychology of what happens after a market breaks out of a range-bound state. In my personal opinion, looking at the markets and tracking the markets and studying the markets, right, it seems to me, right, through the technical glance, that we have moved from, or at least transitioned from, a range-bound market into the very early instances or infancy of an actual trending market. And this is exactly what to expect during the infant stages of a back test. Okay, so I wouldn't be all that concerned about the bearish activity taking place in the market. It is technically healthy through the eyes of a technical analyst, especially on a swing sort of time frame as well. But really what matters at this particular juncture is what happens in and around this green box. Also noticeably, what happens around this intermediate. I'm going to put I on my screen for an intermediate trend line. Let me just recap a little bit and show you this, because whenever you get into, at least draw these technical fan lines or trend lines, or what you can call accelerating trend lines off from the macro primary bullish trend, it gives you buy signals, or at least a location on the chart. That's why I draw these rectangular boxes as to where you can position yourself in the event that markets pull back, and essentially you can buy the market at a discount. And that's exactly how I'm interpreting the price data at this particular point. Again, getting back to the word confluence and what it means, really what we're describing is a multitude of support areas that are showing up roughly or in a rough vicinity to one another. And I've gone through this in the past, but if you want to include that of the trend line as well, you can see how it's starting or very close to actually intersecting with this green rectangular box. It's not perfect, okay? It's more of the art than the actual science of technical analysis. But what you're starting to see, hopefully, is that not only have we closed or very close to closing that open window on the S&P 500, but we're coming back down into the general vicinity as to where we would expect the bullish trend to continue off from. Again, I've recapped, of course, the past resistance is new support, but if you wanted to drill into the molecular level as well, if you wanted to bring up the exponential moving averages, you can see today that we started to see a very little reaction off from that rising 50-day exponential moving average. You can see the moving averages coming in at 2,947. The market's closed, or at least the S&P 500 closed at 2,953. And I just wanted to make the point that the 50 is just the general vicinity as to where, right, market bulls will begin buying the market. It doesn't mean that if we flinch below it and close below it that we're immediately bearish. It's just a general, right, vicinity. That's why I draw these green rectangular boxes as to where we would look for white candlesticks to show up to actually give us the signals that the market is going to continue. It seems as though, as at the close on Thursday, that we do have a number of headwinds at this particular time, but I am still very much so, even today, continuing to enter into SPY positions, right, for dated option contracts, or at least option contracts pushed into 2020 for the continuation of this trend higher. I'm not sure if it's going to sort of play out, over the next couple of days or couple of weeks, but give it, all right, enough time, you should see the markets actually stabilize generally around this area and then continue soon enough to break above what has been that of a recent all-time high towards the very back end of July. Just a couple of trading sessions ago. I need to update you on this because it is very much so important. If I flick on over into the oscillators, what we're doing right now is resetting them, which is fantastic. You can see the RSI is pushing into oversold. The MACD is technically, right, crossed bearish. We're seeing a little bit of sort of an acceleration into negative territory through the histogram bars. That's just the separation of the fast and the slow line of the actual signal line on the MACD. That's all the histogram represents. And the stochastics is crossing down as well. So technically, right, we're in that sort of a resting pattern whereby, again, when you think about a trending state of the markets, it's not necessarily a sell signal whatsoever. It is giving you an opportunity to slowly, again, accumulate positions in and around the vicinity to take advantage of the impending bounce whenever that does come. So again, I'm not bearish on the market. It looks as though we are getting the backtest of this critical area that we have described and at least have sort of forecasted prior to the actual breakout, even in the period of June. Personally, when I was looking at these markets, and I was very open about this, I thought we were going to get stuck in this sort of ascending triangle here, whereby we'd see a couple more wave rotations into the apex of the triangle prior to breaking out. However, the markets themselves, they got excited, they jumped the gun. And now if you think about it, even if we were still in the apex of this ascending triangle, now we're sort of coming back together as to where we would be if we were still within this apex. So I'm not concerned, nor should you be. And I hope anyway that I'm sort of qualming or sort of squashing any concerns that you may have about the state of the markets. The Dow Jones has pulled very much so firmly back into this green rectangular box. It's actually overshot it a little bit. Again, that is expected. That is, again, the art, more so of the exact science of technical analysis. If I bring up the exponential moving averages, you can see this is a very good example of what I was alluding to a little bit earlier, whereby if the markets overshoot the 50, it's nothing, all right? Or at least you don't need to say, well, immediately I need to turn bearish on these markets. A trend, remember, the golden rule is assumed to be in effect until it gives us definitive signals that it has reversed. At the very sort of most aggressive case, it's going to be below this intermediate rising trend line off from the macro primary trend of the Dow Jones Industrial Average as well. So again, we're still very much so firmly bullish. We're not sort of deviating or diverging away from that sort of macro call on the markets. There's still adequate sort of growth in the economy to push these prices higher. We are going to, of course, turn bearish when that opportunity, when that time comes. But as it stands, this is still the ebbs and flows, the market noise. And I think a lot of the distraction is actually getting swept up in the fact that we're actually just simply backtesting the very critical pivot that we've taken more or less 18 months to actually overcome prior to, of course, the breakout that we saw definitively in the period of July. All right, when I flick on over into the S&P, not into the S&P, into the NASDAQ as well, you can see this is the target that we've been looking at. If I just hover my screen over the H, this is the high of that last candlestick in the month of June. You can see it's coming in at 8,010. The close today, if you just look to the right, it's 8,080. So technically speaking, we have roughly 70 points, okay, to move down to actually fill the gap, all right, and actually overshoot that rising 50-day exponential moving average as well. But in the past also, we've spoken about that 8,000 psychological round number and actually retesting it from the top. So we closed here at 8,111. That's giving us more so about a 110-point range to come on back down and actually retest that 8,000 psychological round number. That would also technically overshoot, obviously, the rising 50-day exponential moving average. But even if this does occur, it's a fantastic opportunity. Again, in my opinion, and what I'll be doing anyway is just buying the market as I have done during Q4 of 2018, as I have done again religiously, so to speak, through the period of May, and to a lesser extent as we've continued in our bullish ways really since or ever since through the period of June, and for the majority anyway of July too. So again, it's really fascinating to me, and I say that respectfully, whereby the sentiment or the collective psychology of market sort of participants anyway can shift so abruptly, and whereby when you think about the sentiment up here, once again being extremely bullish, and how it just shifts very, very quickly, very aggressively, whereby there's a lot of people, unfortunately, liquidating a lot of long positions, or at least market positions. And what's going to happen is that they're going to get whipsawed. And above all, I do not want you to get whipsawed. All right, if you have conviction in your beliefs as to where the market is going to go, and if there are no real sort of immediate red sort of danger warnings, either through technical or fundamental analysis, it's best just to hold, in my opinion. That's what I'm doing anyway, through these types of market gyrations, and then understand it for what it is. It's not rocket science whatsoever. But the hardest, when I work with people anyway, one of the biggest sort of factors to overcome is not the sort of the understanding of the analysis. It's not necessarily the application of the analysis. It's more so the emotional impact, sort of that psychological minefield that they're walking into, or at least maybe what they don't understand that they're working into or unfamiliar with, that really messes them up inside their head. And I'm just trying to, again, sit here on a Thursday afternoon and just say, look, I'm not concerned. I don't think that you should be concerned. There will be periods, or there will be moments, say for instance, if the markets collectively were to break their intermediate trend lines, whereby we say, well, potentially we're moving into more so of an intermediate correction. That would come as a little bit of a surprise to me, given that we have now broken above these all-time highs and appear to be backtesting this critical resistance as new support. But time will tell. At this point, really, I'm just sitting on my hands and just looking for, as I did today, opportunities to buy the market at distressed levels. Relatively speaking, this isn't really all that distressed. All we've seen really is 2 days of a pullback. But again, it's fascinating to me whereby people can just absolutely be turn on a dime really and let their emotions essentially get the better of them during these potentially opportunistic times to be entering into the market at a discounted price. Now, on the trading front, we really haven't seen all that much action. Apple still hasn't triggered above the bullish continuation trigger above its earnings call yesterday. In fact, we've closed the gap. And again, a lot of these candlesticks are going to be impacted by the mid-afternoon tweet by Trump. Again, I think it's another 10% on another 300 billion of Chinese imports, further tariffs on the pipeline. A lot of retail stocks today got absolutely clobbered. But again, you can see Amazon still yet to actually trigger into any trades. What we're going to do is stalk these trades. We're going to bring down these entries over time, but at the moment it is too aggressive. Again, here's Boeing Airlines pulling on back down after earnings. Still yet to place a trade on this. Happy for it to come back down to resistance. And mind you, I spoke about this on COP a couple of days ago. It might have actually been yesterday. And what we're starting to pick up on in the way of analysis is certainly bullish divergence. I'm going to put a plus sign here and just write DIV. Okay, for positive divergence, otherwise known as bullish divergence, whereby we haven't actually seen price action register a relative low, but what you can see when it comes to the MACD are a lot of false signals when it comes to the momentum and the depth of the correction through the acceleration into negative territory that we're registering through the eyes of the MACD. So we've got all of the makings here during this little correctional period, right? Whereby a lot of these stocks are going to, again, essentially set up whipsaws like they have done during the period of May and also June that we had our sort of finger right on the pulse of. And what you're going to see, I'm not sure if it's going to happen in the next week or two, but what you're going to see is these stocks turn very quickly, very aggressively, much like the markets, and they're just going to kick off and continue to the upside. So pay attention to that. It's registering on a bunch of individual stocks. Again, I'm just rotating through our top 12 list. No trade on Caterpillar this week. Essentially, this has just gone sideways for about a month and a half at the moment. We're looking for a really good opportunity to enter into it. Again, we're going to bring down a lot of these bullish entries in this weekend's pro analysis class. We got very close to triggering on COP today. Have a look at this. Couple of cents above 60.31 or actually below with this wick even during today's session. But you can see the white candlestick or the white body developing around this pivot, this very critical trend line on COP. So there are some interesting sort of setups in the works. Disney, no surprise there, pulling back down to support with the market momentum moving to the downside today. We've got Google again setting up what appears to be that of a bull flag, but at the same time we could see this close the open window. Again, this is perfect because we're building the structure, which is fantastic. So what we'll do again is just stalk these trades as they continue to pull on back down. IBM had an upper wick today above 152.50, which is a little bit of a pain in the backside, so to speak. White candlestick nonetheless, but we are still treading water. If I bring up the exponential moving averages, you can see once again, it really looks as though we're going to see a trampoline off one of these exponentials, whether it's the 10, whether it's the 20, who knows what it's going to be. Potentially we might even actually close below that of yesterday's session. But all in all, we're still in that of a trending market for at least the indices and also the majority of individual stocks that we're following. Microsoft again, pulling on back down. If I can bring it up, or at least it sort of held steady anyway. It was one of the better performing stocks, but largely sort of just impacted by the market, up $1.79. It didn't break, which is good. So it's still technically around the pivot, which is fantastic. That 141.20 after earnings is still sort of lingering. It's searing a little bit. It's simmering away, but at the same time, fairly confident in that. You're just going to have to be sort of persistent through this little bit of turbulence in the market itself. And Netflix, unsurprisingly, pulling on back down. Watch for this. I've spoken about this in detail, very similar to the type of reversal that's set up in Google, another stock whereby you can see a little bit of divergence forming if you want to go into the MACD indicators as well. Very quickly too, I just wanted to bring up the US dollar yesterday. It had a tremendous sort of rally to the upside. In fact, what we did yesterday was break above and close above a lot of this resistance that we've been contending with for the majority of 2019, which is fantastic. So again, we haven't really had any trades on the dollar, or at least we've shied away from them, simply for the fact that it's been tremendously volatile. And the same is true when you link, or at least go through into market analysis with the US dollar and change it, or at least intertwine it with GLD and also SLV too. So we've been staying away from all three of these markets, the dollar, GLD, and SLV. But interesting to point out anyway is that we try to continue. But on the back of anyway, the tweet, again, can't believe I'm mentioning tweet. It's rather ridiculous, but here it is. You're seeing how the US dollar is being impacted, down 23 cents. But when I bring up the exponential moving averages, you can see that we're still firming up and holding up above it. In fact, we're quite a distance away anyway from that rising 10 exponential moving average. So again, the US dollar is looking, relatively speaking, quite strong as to what it has been, especially during the period of June. It is strengthening and it appears to have actually broken out. So when you look at the upper targets of the US dollar index, if I can bring it down, you're still sort of looking at that psychological round number of 100 acting as a magnet, which should pull and drag these prices on up higher. We're closing at 98.34 as at the close on Thursday. So again, just be mindful of that. It's going to be a significant headwind for gold and both silver. But as it stands, really our concerns, or at least our focus, should certainly be on what the indices are doing. Okay, so I hope that's helped you. try to disconnect your emotions from the market. Try not to be really impacted by them, and just understand that this is the gyrations, the ebbs and flows. This is essentially the market noise and what appears to be the backtest of this C, the multiple support areas that are contributing to the word confluence at this particular juncture. That's what you need to understand. That's what you need to think about. And that's what you need to really sort of find out, or at least be content with at this particular time. All right, if you want to learn more about that, jump into that pro analysis class. I'll be sitting down on Saturday this week to record that. And we'll be going into more detail, just what's happening sort of under the surface, under the hood, so to speak, of the markets themselves. It's going to be interesting to see how Friday plays out, especially on the S&P 500, now that we've more or less closed this open window. And it is probably, of the three closely followed markets, the one that is more or less in the sweet spot as to where we would expect certain things to arise, or at least begin to see the beginning formation of white candlesticks around the support area. All right, so on that note, everyone, I'm going to say farewell. Enjoy your Thursday evening. I'll be back with you in due course. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.